So if you add all this together, the momentum trade unwinding perhaps, not just in AI, but across sectors, and uncertainty about a December rate cut, with all that, where does that leave investors? Well, CFRA Research Chief Investment Strategist Sam Stovall and HSBC Global Private Banking and Wealth Management CIO Jose Rasco join me now. Welcome, guys. Jose, what kind of rotation are you seeing here?
Well, I think there's concern about the Fed, right? No question about it. And I think it's well placed because if you look at what the Fed officials have said, and we don't have a lot of data. But this now, what's concerning for us, we're still pro risk, don't get me wrong, and we're still like equities going forward. But I think if you get a scenario where the Fed disappoints, and God forbid, earnings disappoint going into Q1. There could be some repricing at the beginning of the year, and you have to remember we've been applauding the fact that the Mag 7 is going to slow in earnings from 18% in Q4 of this year to 14% next year, while the forgotten 493 is going to go from 2% growth in the fourth quarter of this year to 15% next year, John. So we've been applauding that broadening of the market. The concern we have is AI is going global. So demand for these products, these inputs to continue to drive this tech revolution, there's a lot of pressure on that. We may see that earnings may take longer to filter through, which means multiples could look a little pricey as we begin the new year. And so don't be shocked by a short-term adjustment in Q1 to valuations, but we think we're still pro-risk. We think the economy's good and the fundamentals still look very strong.
Okay. So, Sam, that raises a greed question for me, right? Everybody out there who's been decently invested through this period has done pretty well. How much dry powder do you take off the table now for the potential of some real volatility, some dips, and some buying opportunities over the next couple quarters?
Well, John, I think that the exposure that investors might have would be relatively minor because my research shows that while they might feel as if they're behind the eight ball right now and growth investors have been giving up some returns and seeing rotation into the more defensive areas of consumer staples, healthcare, energy. My belief is that whatever decline we get historically probably is going to be less than 10% and would represent a very good buying opportunity because as we head into 2026, as Jose mentioned, earnings are expected to be up about 13%. 2027, earnings expected to be up more than 14% for the S&P 500, with tech leading the way in both years. So I would tend to say that investors should be taking this as a buy the dip opportunity.
Okay, but Jose, even a high single digits dip is probably going to put some people's hair on fire, those who have hair, because we haven't seen something like that in quite a while. So if you're going to take advantage of that, though, you got to have dry powder. A lot of investors are a lot more weighted toward equities than they have been historically. Yeah. So if you're in that position in your portfolio, what should you do?
Well, we just upgraded hedge funds again. We think, especially at this point in the cycle, from a global asset allocation perspective, you want to look at hedge funds. They tend to do well when the economy is slowing. And so we think that makes a lot of sense. We've over allocated there. We've gone overweight there. And then we want to play that global AI. I was just in Mexico 2 weeks ago and conversations with clients about what's happening in AI in some of the emerging market countries would really set what little hair I have left on fire. And so I think you really want to look at that. I agree with the comments that were made by your other guests. And I think this is a global phenomenon. I wouldn't say buy the dip because my compliance team would yell at me, but I would say it's certainly a buying opportunity if you see any weakness in this, because this trend is going on for a while. So we remain bullish. Yeah.
So, Sam, for those retail investors out there who are maybe playing with margin and options for the first time, and there are quite a few of those here, how should you think about this next period? How do you need to make sure you're positioned, though you do say that you're still long risk, I think?
Yes. Well, first off, that kind of a question about margin and about options being directed to somebody who wears both a belt and suspenders is probably not appropriate. Our focus is either buy, hold, or sell of equities within the U.S. primarily. But my feeling is you just remind yourself that historically, of the more than 65 pullbacks or declines of 5 to 10% since World War II, it's taken only a month to go from peak to trough and less than a month and a half to get back to break even. So you've got to be very right very quickly on both when to sell and when to get back in. So my advice would be rotate, don't retreat. If you wanted to make some shorter term moves, focus on where the relative strength is, such as the S&P 500 pure value over the S&P 500 pure growth at this time, which does incorporate many of the sectors that are doing quite well right now.